Welcome back. SPACs have burst into the mainstream this year in a speed and veracity that few pockets of finance have seen before. It's why we're taking a closer look this week in a segment we're calling SPAC in Action. SPAC stands for Special Purpose Acquisition Company. It begins with a sponsor, usually some well-known person in business or finance, who works with an underwriter to raise capital through a listing. Investors in the SPAC are writing essentially a blank check to the sponsor to find a future merger target within a certain period of time, usually about 2 years. That sponsor automatically gets a hefty payday, typically 20% of the equity. New investors can redeem at the listing price plus interest if they choose to. That can help protect investors' downside in a world where there's little yield. SPACs have become increasingly popular. More capital has been raised by SPACs this year than in the prior decade combined. In fact, the explosion of capital going into SPACs is just $8 billion shy of eclipsing that raised by IPOs of operating companies this year. And it's no slow year for those types of IPOs, but this party can't go on forever. Cracks are starting to form. We'll get into those later this week, Wilf.
I'm looking forward to much more of this weekly segment. My question to this particular first one, Leslie, is who helps them raise the money? And are the fees for that comparable to traditional means like a company IPO that's already an established company?
It's a very good question. They're your traditional underwriters that you see in the IPOs of operating companies. So, they're the big, large banks that will take a company public. They will also take public these SPACs. Historically, there were certain firms that used to shun this type of underwriting, but this year in 2020, pretty much every firm across the board is willing to do that. Now, the fees are similar to that of an IPO, but typically the big difference here is that you'll see fewer underwriters on these deals. You may see just one underwriter as opposed to an IPO of an operating company where there could be as many as 35 underwriters that are all kind of selling that stock to their clients. So that would be the key difference, is that the pie is still pretty similar in terms of percentage, in terms of that gross spread, but it's not spread among as many banks. So if you are that single underwriter, you get to take home a nice paycheck from underwriting that kind of deal.
Well, there's been a lot of those being issued this year, I guess. More in the SPAC in Action. Great tagline as well throughout the week here on CNBC and on Closing Bell in particular.
Shepard Smith here. Thanks for watching CNBC on YouTube.